Good morning and welcome back to Almus Market Mornings. Amid the lack of economic data coming from the US, markets are paying close attention to the private data. Yesterday's data from Challenger Gray and Christmas Inc. Showed almost triple the number of job cuts as previous year. The headline figure showed job cuts of 1,53,000, primarily driven by technology and warehousing. Despite this number, a lot of Fed members continue to remain concerned about inflation, which is causing a hesitation for the Fed to commit to a December rate cut. Good morning, JK. How significant is this Challenger job cut sprint? Do you think that would help sway Fed members into committing to a December rate cut?
Good morning, Swaraj. So usually these challenger job cut numbers are not given much importance by the market. And in the absence of any other major number, market has reacted to this number. And also significant is that this number has come quite contrary to the ADP number, which was actually seen as positive, creating additional 52,000 jobs in the month of October. So these layoffs are now, caused by, corporate spending coming off, AI adoption, and even consumer spending coming off, rising costs also, which is leading to belt tightening and hiring freezes. I think market now again normally would have got this BLS unemployment report for the month today, but that is going to be missed. But market forecasts indicate that unemployment rate might have each hedged up to 4.4% from 4.3%. So that is something to keep in mind. But it's still a matter of speculation what the exact number is. But it can. I don't think the number would have been better, even if it was announced as per schedule. Then of course we had the markets reacting quite negatively yesterday overall. The yields have once again dropped after rising in the morning or the previous day after the good services PMI number, as well as the ADP private jobs number. But the fall in the market initially was tied to the very weak challenger report on the job cuts. But the two important matters of concern for the investors. OpenAI has been seeking a government backstop or federal government backstop for its committed 1.4 trillion investment in infrastructure and hardware build. That is something that they're seeking for financing to happen smoothly. But we did see in a tweet by Trump also that federal government is not going to bail out any AI company. So that was some concern for the investors, and also, there is a risk that if it is, done, there is a possible taxpayer risk also if that happens. Another negative news was one of the largest European banks plans to sell some of the AI stock holdings, because in order to safeguard their lending, large lending to AI company in Europe. So I think we are seeing more and more emphasis on the AI bubble. So we actually saw the equities yesterday in US drop heavily. This was after a big drop seen on Tuesday, followed by some sort of a recovery on Wednesday. So it does look like we are getting into a zone of good correction in the market. And market is also now started to focus more on the record government shutdown, record period of government shutdown, possible strike down of tariffs by Supreme Court. Of course, the hearing is still going on, and the weak jobs report. All these things have resulted in markets. So I think the market's focus now is how. Rather, investor focus now on how the AI sector stocks or performing in the coming days, and there is an apprehension that if it continues to slide, it can drag down the other markets as well. Uh, and of course, we also had huge market meltdown, which can a huge market meltdown can actually threaten a slump in overall economy, and this expectation actually can just steamroll the uh, cautious stance by uh, Powell, and see that the rate cuts are done faster and larger. But that is something that we have to wait and see if there is a big meltdown or not. Now, dollar also gained the dollar's gains were actually truncated after this report on job cuts, as well as the fall in the stock market. Euro gained with its newfound status as a safe haven. Yen gained as I suspect there were some carry trade unwinds as well. GBP also gained as Bank of England held its rates unchanged, but also said that their approach to rate cuts would be gradual, because their inflation is still hovering around 4%, and it is not coming down easily. So overall, dollar's gains of the last couple of weeks seem to be, on a hold, or it may even end if the asset markets continue to slide, and markets take a negative view on the dollar, because that it can have a bit deeper impact on the economy, and maybe, who knows, Powell comes back and cuts rates faster, and by a larger measure also. That is something that we will continue to just focus on. Yeah, on the Indian side, we have had the rupee, which seems to be kind of settling in, slightly stable range. Most thanks mostly to the action of the central bank. But if you look at it, both the stocks and currency in India have been charting their own courses, ignoring the global trends. Stocks have mostly underperformed global peers. Weakened whenever the global markets fell, but remained sideways or fell modestly during their rise. So FI's negative approach has not changed, with their net investments continuing to be negative even in this month. Rupees volatility just ahead of its all-time lows definitely is because of RBS intervention, and whenever it tended to weaken more. At least for now, they have successfully contained any speculative moves, and all the action is due to genuine flows. But the genuine flow, as we have seen, is from the buying side only. In fact, the currency is moving in either direction, irrespective of global cues, as I said, influenced by flows and what the central bank does. But just to give a broader perspective going forward, any larger trend can emerge only if the global market gets into big risk-off mode and foreign investors selling intensify. Then we can see the rupee break into new lows. A negative outcome in the ongoing election in Bihar for the ruling party at the center can also be seen, somewhat negatively for the rupee. On the positive side, of course, a favorable trade deal signed with the US, or Fed cutting rates aggressively with a weaker economy, or even the dollar resuming a medium-term bearish trend for whatever reason, can all support the rupee. But till any of such developments happen and we see a breakout or breakdown in the dollar against the INR, we should respect 87.70 and 88.80 range, with a slight upward extension to possible at 89. Otherwise, I think markets await more developments on the equity market, and whether it spills over into other assets or even other markets is what I am looking to see.
Thank you, Jack. And I think it's pretty clear the extended rally in the tech sector, especially in the US, that's been on the concerning side for a long time. Many investors have been raising concerns on the extended valuation. And of course, any such sort of development which is slightly on the negative side is seeing markets correct very sharply. And that just shows you the extent of this extended rally. Yesterday, after OpenAI, which is the maker of ChatGPT, seeked the government backstop on its huge 1.4 trillion infrastructure spend, investors were quick to sell US equities, and that's what we have been dealing with. Yields have also dropped. Dollar more recently has lost its gains, but that can be primarily attributed to the Challenger job cuts report, which usually in the scheme of things, markets don't pay much attention to. But as it's a government shutdown, any data is being clung on by investors. Bank of England yesterday kept rates unchanged. Their approach to rate cuts would be gradual as they suffer from sticky inflation. And on the domestic market front, rupee seems to be settling in a stable range. The central bank has been quite active. Despite global cues, rupee continues to trade basis flows and central bank action. That's it from us today. Thanks for listening. We'll catch up on Monday with a fresh round of updates. Have a very good weekend.